By the end of this video, you are going to learn my value investing method, and more importantly, how you can use it yourself. We're going to do it in 3 steps. So number 1, you're going to learn all about Benjamin Graham. If you haven't watched my last video, watch it and it'll tell you a bit more about him. Number 2, we're going to look about what fundamental analysis is compared to technical analysis, and why it's the only thing I care about. And number 3, my quick glance at how I, the blink of an eye, or maybe not quite that quick, how I figure out what a stock is worth. Fantastic. Welcome back to video number 2. When I first started investing, I lost money. Stock picking, that is. Index funds are pretty easy going, but when I first started investing, I lost money, not because I had beginner's bad luck, but because I didn't have a system. I bought what was popular and I paid for it. A lot of these companies are companies that are your Googles and your Teslas, and companies that have really high P to E ratios. Now, if you don't know what that is, we're going to talk about that later on in this video. Let me save you though from the same mistake. Right, let's go. In my first video, I told you I've beaten the market, well, the S&P 500 over the last couple of years. I'm not a hedge fund manager, I am a teacher. The reason I've done it is not luck, it's just a method I use that has really kind of become second nature. And that method comes from a guy, or he's rooted in a chap called Benjamin Graham. He taught Warren Buffett, and he literally wrote the book on value investing, the Intelligent Investor. Read the up-to-date version, not the 1949 version like I was telling you about last time. If you've never heard of the book, don't you worry, I'm going to give you the greatest bits right here. And if you have heard of it, this is why it works. We're going to talk a bit about why it works. So if you're new to investing and don't want to gamble, this is it. Not about doing anything completely like rolling the dice at the craps table. Quick disclaimer before we start, I'm a teacher, I'm a school teacher, I'm not a financial advisor. Nothing in this video is financial advice. These are my opinions and it's my personal strategy, so this is not advice. You need to do your own research before you buy any stock. Right, let's go. After that's done with, part 1. Who in the world is Benjamin Graham? Benjamin Graham wasn't a YouTuber, he wasn't a day trader, he was a professor and an investor during the Great Depression, or just after actually. His big idea was simple: buy stocks for less than they are worth. He called this the margin of safety. So you need a margin of safety when you buy a stock. So let me explain this in a really simple way with a hypothetical little thought experiment for you. If you have a company that is worth £1 million, the price to equity ratio, scratch that, let me start that again. Let's go through this as a little hypothetical and a thought experiment. If you have a company that has a price to book ratio of 0.5, that means the actual value of all the assets and everything the company owns is half the price of the current stock. So, for example, the price to book, the PB ratio is 0.5. In very simple terms, if you pay £1, you're getting £2 worth of money. That's a very simplified way of doing it. And the crux of it is, that was basically how Benjamin Graham would look at investing. Buy something that is worth more than the current market price. Now, good example, just to clarify for you, there's other things we're going to use, not just price to book ratio, but price to book ratio is a very important one. Price to book ratio is basically, you take the stock price, you take all the value of all its assets, and then that's a ratio. Usually it's not like you're at the races, so it's not like you have an 8-to-1 or whatever, it's done in a decimal way. So if you have 0.5, that's half the price is half of the actual value. If it's over 1, it's more. If it's 1 exactly, the cost of the company is equal to all of its assets. There are other things that go into it, but that's a really simple way of looking at it. Now, I'm going to say this as clearly as I can. I'm going to try and paraphrase Benjamin Graham. The reason you have a margin of safety is to cut out all of the risk for the future. Basically, if you've got a really healthy margin of safety, you're not going to have to worry too much. There's a bit of risk in everything, that's part of investing, but you're not going to have to worry too much. I love that line. That means you don't have to predict the future. You can just invest your money in, set and forget. So step 1, the market's emotional. Actually, Ben Graham calls it Mr. Market. I'm not going to go into that now, but the market is emotional. You do not have to be emotional. I'm not emotional. Things go up, things go down. I think that almost burping I was doing there is saying I should drink some coffee. That's what that's saying. So the market's emotional. You don't have to be. Oh, and maybe just at the end of this segment, I want to have a bit of a call to action. I mentioned in my last video, I'd love to start this learning community. So on screen, I'm having to read my script here. Have you heard of Ben Graham? Let me know if you have. If you haven't, I mentioned in my last video about my biggest stock mistake. Let me know, what's been your biggest stock mistake or investing mistake in general? I'm really interested here, and I will reply to every comment I get because, as I've mentioned, as of yet, as of filming, no subscribers and no comments. So I will try my best to reply to every comment. I really want to get engaged with this. Right, part 2, learning step number 2 of our success criteria. Fundamental analysis, the only analysis that I do. There's another thing called technical analysis, which we might talk about a little bit, but we're gonna talk about fundamental analysis. What is it? Why we do it. So it's essentially the way you value a stock. You look at the fundamentals of the company. If a company is making loads of money and it's reasonably priced, it's probably a good buy. Problem is, the market tends to be emotional. And if a company is making loads of money, like a lot of tech companies make loads of money, the market prices that in and goes overboard and actually says these companies are more valuable than what they actually are. So we're looking for companies that are a bit boring, that kind of are in the middle ground. That is the crux of fundamental analysis and why we do it. Right, here are the 3 that I'm gonna look at. This is my little secret, I'm telling you now. Write these down if you have a pen or paper. If not, put them in your head. We will see if it'll work. I don't know, let's give it a go. Number 1, the price to earnings ratio. Maybe the number 1, for me, perhaps could be the number 1 part of fundamental analysis. The number 1 thing you need to know. It tells you how much you're paying for everything of their earnings. So for example, if you buy Tesco's a supermarket here in the UK. If you buy some Tesco stock, I don't have any Tesco stock, so I have no idea. But let's say, for example, their price to earnings ratio is 1. That means for every pound you invest, their earnings are £1. So the stock price is equal to their earnings. Very rarely you get that. There's other things like you'll hear EBITDA thrown around, EBITDA or EBITDA or however you want to say it. I don't use it because it's before taxes. And actually, let's do some YouTube magic, and I'll make the definition appear on screen because I don't know it, because I don't use it. I just don't think it's worth looking at, because looking at paying using a metric that is before tax, it doesn't make any sense. We're interested in the money that you get at the end of the day. I don't care about before all of that, because you could do some fancy accounting tricks. I don't want that. I want what is sustainable at the end of the day. So for P to E, lower is generally better. So a P to E of 10, that's quite good. That's generally quite good. That means you're getting, let's say the stock is £100. That means for every £100 you invest, the company earns £10, which is actually, that's generally quite generous. That's generally quite a good P to E ratio. And you don't see that I doubt any tech stocks whatsoever have a P to E of 10. If they do, let me know, because I'd be really interested to have a look at that stock. A P to E of 30 means you're paying £30 for the same pound of earning, the same amount of earning, or it could be any currency. If you're in dollars, if you pay 30, if you got P to E of 30, it's every dollar of the stock you're paying 30 times the amount for. Not worth it in my opinion, and I'll explain why in a moment. Number 2, price to book ratio. This can be really useful, but if the company's not making any money, if it has a low P to E ratio, it might be kind of useless. But it is, to me, it is still very, very important. So basically, price to book ratio is the current stock price and the current book ratio. Book just means everything, so all the assets the company has. Although, note, caveat here, this does not include debt. So that's not on the books for some bizarre reason in the vernacular of price to book ratio. The book is just all the assets. So if PB is under 1, you're buying the company for less than it would cost just to shut it down and sell everything, in theory. So for example, after the 2008 crash, most of the banks, if not all, were selling at a P to B ratio of less than 1. Still now, even after COVID, still somehow the banks are still trading at quite a low P to B ratio. It could be because no one trusts the banks. I don't know, you tell me, what do you think? Number 3, debt to equity ratio. Now for me, this is like the secret number 3. A lot of platforms don't show you this, so I use a free trade. They don't show you this on their little fundamentals screen. Although I would like to see if they could figure, that's maybe feedback I can give to free trade, show D to E ratio, although I can see why it's hard because they don't report it all the time. And it obviously depends, it changes depending on the stock price. But that same idea, you want a low D to E ratio. You want a company to have low debt compared to their equity. So if a company has got a D to E ratio of 0.1, that means 10% of their company, 10% of the total equity of the current stock price is debt, which actually is not too bad. Depends on their peers. You always have to look at the peers, but that's not too bad, if I'm honest. A company with low debt and a high P to E ratio and a low P to B ratio, that's the magic there. If you've got a company that's making a lot of money and they don't have a debt and they're quite cheap compared to their assets, if they're lower than their assets, that's number 1. A lot of these are quite boring. You're looking at things like furniture manufacturers, things like that. And I think Warren Buffett's company, Berkshire Hathaway, started out as a textiles manufacturer. I'm not too sure, but it's really boring. But they make money and it's a great way to great thing to put your money into. Now, I want to compare this to technical analysis. Now, technical analysis is what day traders look at. So if you think of, you might have seen these candlestick charts, that's what day traders look at. They look at the short-term trend. So, and ideally, if you're a day trader or something else called a swing trader, which is longer than a day, but less than a long-term investor. If you're a trader, you're looking at the trends and you're trying to capture a trend. We're not looking at that. The stock market could be closed for 10 years. We don't care. If the company's good, that's good news for us. And it's like you're a business owner. You're owning part of a business. I look at a business long term. That is fundamental analysis. If you're investing for the long term, fundamental analysis is the only important and type of analysis. Obviously, that is in my opinion. Actually, I'm going to show you now. I'm going to have a look on my right. I'm recording my screen now. So let's have a look at. I've just loaded up HSBC as a good example for this. So you can see a lot of these things are just for day trading. You're not going to care about them. Like the day range, don't care. This is for looking at trends. We are looking for things like this. This is the PE ratio. So HSBC has a price to equity ratio today of 15.04. Fantastic. That's reasonable. It's also not great for a bank, but it's reasonable nonetheless. You do not want to look at the forward P to E. That is like their projection. You don't care about that. That's a made-up number as far as you are concerned. We're going to look at their trading, things that has already happened. This is concrete. We know this. I don't want to look at any fancy pants forward P to E. That is kind of made up. P to E 15.04. That's not bad. Our price to book, trailing here. Oh no, it's price to sales, sorry. Our price to book, 1.56. I mean, that is quite high for a bank, but overall, not too bad. We can't see total debt to equity here. It's not here. Yahoo doesn't have the information. There's ways you can find that. If you look through their financial reports, you can easily find it. Obviously, it depends, the D to E depends on the time. In any case, for this example, I probably wouldn't buy this now, although if it got cheaper, if the price went down, it could be a buy for me. Looking at the fundamental analysis, and also there's other factors that go into it. Like it's got quite a good reputation. Call to action number 2. Here's a challenge for you. Go pick one company you like. Now it could be Apple, it could be Google, a tech giant, it could be maybe your local supermarket, it could be where you work, it could be anywhere. Go and have a look, find out those numbers. Find your P to E of that company, P to E, find the P to B ratio, find the D to E ratio, and tell me what you think. Tell me, do you think it's undervalued? Do you think it's overvalued? What do you think? I'm getting you to do my market research here for me, because there's a lot of these things that I don't know. There are these hidden gems out here that I don't know about, and I would love to hear from. And maybe I'll share some with you as well in future videos. My commitment as well at the moment is that I'm going to reply to as many as I can. Again, new channel, want to try and get as fully involved as I can in the learning community. Right, part number 3. I'm going to have a swig of coffee before this. My quick glance method. Now, I'm going to use a concrete example for this. I'll load it up now. So this is where I give you a peek behind my magic curtain. Does that sound weird? It does sound a bit weird. Peek behind my magic curtain. Okay, scrap the magic curtain analogy. We're gonna have a look in my box of goodies. Oh God, I can't seem to get a good analogy. Anyway, let me fill you in. God. So I'm not gonna give away my whole method, of course, because I've got to keep you coming back for more, of course. But I'll show you kind of a quick glance method I use when looking at something. So we're gonna look at an overpriced stock, we're gonna look at maybe an underpriced stock, and we're gonna look at maybe a reasonable stock. That's in my opinion, of course, not financial advice. So let's have a look. Right, we are back here on Yahoo, which I should be able to have a look and find, this was our last one, HSBC. HSBC, we've just talked about it. I'm gonna say that's reasonably valued. One way I'm going to work that out is if you take the price to earnings ratio. Let me pull up a calculator. Come on, calculator. We pull up a calculator. We take the price to earnings ratio up here, so 15.04, and then we're going to multiply that by, where is multiply? It's clearly been a long day. We're going to multiply that by the price to book ratio, which we had here at the bottom of 1.56. So we're going to multiply that by 1.56. Now, my magic number is if it's less than 25, I think it's reasonable. I would put this on my watch list. If it's less than 20, you have to do more analysis, but I'm going to put this on my watch list because I'm quite happy with that. 23.4624. At a quick glance, it's less than 25. It could be a diamond in the rough. Let's look at something that might be slightly overvalued, shall we? So let's go to, I'm gonna go have a look at Tesla. I love Tesla, and obviously my opinion is, it can be quite divisive. I don't want to talk politics, but I do think it's one of those companies that really is exciting. But we're looking at boring companies here, really, really boring stuff. Okay, let's have a look then. Go down to the bottom. So remember, it's the trailing PTE. Oh my days. I had no idea it was that high. Let's open up our calculator again. We go 323.1. Okay, and we're gonna multiply that by our price to book, which is 15.94. So actually the price to book isn't too bad. Okay, so you tell me, is that more or less than 25? Because that's unfortunately, I would love to buy Tesla. It's way out of our value investing parameters, so I'm not going to go anywhere near it, unfortunately. That was a concrete example for you. Let me know what you think. Let me know if you have any others that you work out the numbers on, because I'm really excited to hear about it. That's my quick at a glance method. Now, listen, this is not like a buy. I'm not telling you to buy anything. This is kind of a screening method you can use. It's a filter to work out whether a stock is good or not. Again, I want to say that again, this is to tell you whether it's meeting our value investing parameters. Right, this is another call to action. Comment me a ticker and I'm going to check it out. So a ticker is just 3 letters you have usually. Like for example, I think Goog is Google. I'm not too sure, but just comment me a ticker on the bottom. I'll check it out and I'll see if I can, and I'll tell you what I think. And maybe you can tell me what you think as well. But like I say, my quick glance analysis will probably tell you what I'm going to think. If you recommend, I'll go and look at Tesla, which we've just looked at. I think it's a fantastic company, but it's just far too expensive for us, unfortunately. So I will tell you that. But ask me in the comments. Let's have a look. Let's work together on this. Right, let me quiz you really, really quickly because I'm a school teacher, as I've said a couple of times. That's what teachers do. Number 1, who is the godfather of investing, of value investing? Did you say Benjamin Graham? You're shouting at the screen, Benjamin Graham? Then yes, you are right. And 2, what do I look at instead of stock charts? We don't care about stock charts. The business itself, not the price. We don't care about the current price really. We care about what the business is made up of. Question 3, what is my quick glance rule? Yes, if you're shouting at me, price to book ratio multiplied by price to earnings ratio. If it's less than 25, I say my quick glance rule. I don't want to plagiarize anyone. Benjamin Graham's quick glance rule. So we'll rephrase that, the quick glance rule. But yeah, that's what I would definitely use. If you've got all three of those answers, you're already ahead of most beginner investors. Right, now if you haven't watched my first video yet, please do. Please have a look. I'm gonna try and make it appear somewhere around here. Not sure how to do it yet, but we'll have a look. In that video, I break down exactly how I've been beating the market, specifically the S&P 500. It's going to be the same honest, easy to understand breakdowns. Hopefully this is coming across as easy to understand. I don't want any of this let's get rich quick nonsense. If you want to do something quickly, do it slowly. That's my honest advice. I built this second video on top of that foundation. So I'm trying to layer things on top of another. So if you want to know the full picture, if you want to know the full picture, look at that video and I'll see you in it. Thanks for watching. Go and be a patient investor, and I'll see you in the next video. Hopefully, well, I won't, but hopefully I'll hear some comments.